A comprehensive look at types of retirement accounts. Introduction. Saving for retirement is one of the most important aspects of your financial life. With fewer and fewer companies offering traditional pension plans and Social Security at risk of going bankrupt, the responsibility for ensuring a comfortable retirement has shifted largely to individuals. Understanding the various types of retirement accounts available is essential for making informed decisions about your financial future. This video is a follow-up to the previous one where I introduced the basics around saving for retirement. Here I will provide a more in-depth look at the different types of retirement accounts, their features, advantages, and considerations. Hopefully this will help you to understand better the types of retirement accounts available and to choose the right retirement savings vehicles for your unique situation. Before I start, let me say that this is not investment advice and this video is for educational purposes only. It is best to consult a financial advisor before making any investment decisions. Let's get into it. Employer-sponsored retirement plans. Employer-sponsored retirement plans typically fall into two categories: defined contribution plans and defined benefit plans. A defined contribution plan is a type of retirement plan where the employee and/or the employer contribute a specific amount or percentage of earnings to the employee's individual account. The eventual retirement benefit is based on the total contributions and the investment performance of those contributions over time. Defined contribution plans include 401k and 403b plans. A defined benefit plan is an employer-sponsored retirement plan that provides a predetermined, guaranteed benefit to employees upon retirement. The benefit amount is typically based on a formula that considers factors such as 1. The employee's salary history, often an average of the highest earning years. 2. Years of service with the employer. 3. Age at retirement. A traditional pension plan is an example of a defined benefit plan. Defined contribution plans have largely replaced defined benefit plans in the private sector due to their lower cost and risk for employers. They give employees more control over their retirement savings but also place more responsibility on the individual to ensure adequate savings for retirement. I will now take a more in-depth look at the different types of retirement vehicles. A. 401k plans. Definition and basic features. A 401k is a tax-advantaged retirement savings plan sponsored by an employer. It allows employees to save and invest a portion of their paycheck before taxes are taken out. Traditional versus Roth 401k. Traditional 401k. Contributions are made with pre-tax dollars, reducing taxable income. Withdrawals in retirement are taxed as ordinary income. Roth 401k. Contributions are made with after-tax dollars, and therefore have no immediate tax benefits. Qualified withdrawals in retirement are, however, tax-free. Contribution limits. For 2024, employees can contribute up to $23,000 annually to their 401k. Those aged 50 and over can make an additional catch-up contribution of $7,500. Employer matching. Many employers match a percentage of employee contributions, essentially providing free money for employees' retirement savings. Vesting schedules. Employer contributions may be subject to a vesting schedule, meaning the employee must work for the company for a certain period before fully owning the contributions. Investment options. 401k plans usually offer a range of investment options, including mutual funds, target date funds, and sometimes company stock. Loan provisions. Some 401k plans allow participants to borrow from their account, although this should generally be considered a last resort. Loans must be repaid with interest. Advantages of 401k plans. 1. Tax-deferred growth. 401k plan investments are deducted from income before taxes are paid. 2. Potential employer matching. 3. High contribution limits. Disadvantages of 401k plans. 1. Limited investment options. 2. Potentially high fees. 3. Withdrawals taxed as ordinary income. 4. Early withdrawals, before age 59 and a half, may incur penalties. B. 403b plans. Definition and eligibility. 403b plans are similar to 401ks but are offered by public schools, nonprofit organizations, and certain religious organizations. Similarities and differences from 401ks. 403(b) plans function similarly to 401ks in terms of contribution limits and tax treatment. However, they may have different investment options, often including annuity contracts. They may also have different eligibility criteria. Contribution limits. The contribution limits for 403(b) plans are the same as for 401k plans. Special features of 403(b) plans. Certain long-term employees can make additional catch-up contributions if they've worked for a qualifying organization for 15 years. C. 457(b) plans. Definition and eligibility. 457(b) plans are typically offered by state and local governments and some non-profit organizations. Contribution limits. The basic contribution limits are the same as 401k and 403(b) plans. However, 457(b) plans may offer additional catch-up provisions. Unique features of 457(b) plans. Unlike 401k and 403(b) plans, 457(b) plans do not impose a 10% early withdrawal penalty for distributions made before age 59.5. D. Thrift Savings Plan, TSP. Definition and eligibility. The TSP is a retirement savings plan for federal employees and members of the Uniformed Services. Structure and investment options. TSP offers both traditional and Roth options, with a selection of index funds and lifecycle funds. Contribution limits and matching. Contribution limits are the same as 401k plans. The government provides matching contributions for most participants. E. Pension plans. Defined benefit plans. How they work. Defined benefit plans promise a specified monthly benefit at retirement, often based on salary and years of service. Calculation of benefits. These plans typically use a formula considering years of service and final average salary. Pros and cons. Defined benefit plans provide guaranteed income but are becoming less common due to high costs for employers. Cash balance plans. Features and benefits. Cash benefit plans are a type of defined benefit plan that resembles a defined contribution plan. Each participant has an account that grows annually. Differences from traditional pensions. Benefits are expressed as an account balance rather than a monthly benefit. That's it for employer-sponsored plans. Let's now take a look at retirement plans that individuals can create for themselves without going through their employers. Individual retirement accounts, IRAs. A. Traditional IRA. Eligibility and contribution limits. Anyone with earned income can contribute to a traditional IRA. For 2024, the annual contribution limit is $7,000, with an additional $1,000 catch-up contribution for those 50 and older. Tax deductibility rules. Contributions may be tax deductible, depending on your income and whether you're covered by an employer-sponsored retirement plan. Investment options. IRAs typically offer a wide range of investment options, including stocks, bonds, mutual funds, and ETFs. Distribution rules and penalties. Withdrawals before age 59.5 may incur a 10% early withdrawal penalty, in addition to regular income taxes. Required minimum distributions, RMDs. Individuals must start taking RMDs from an IRA at age 73, as of 2024. B. Roth IRA. Eligibility and income limits. Contributions to a Roth IRA are subject to income limits. For 2024, the limits phase out between $146,000 and $161,000 for single filers, and $230,000 to $240,000 for married filing jointly. Contribution limits. Contribution limits for Roth IRAs are the same as for traditional IRAs, $7,000 annually, with an additional $1,000 catch-up contribution for those 50 and older. Tax treatment of contributions and withdrawals. Contributions are made with after-tax dollars. Qualified withdrawals in retirement are tax-free. Conversion strategies. Some individuals use backdoor Roth strategies to contribute to a Roth IRA despite being over the income limits. No RMDs for account owners. Unlike traditional IRAs, Roth IRAs do not require minimum distributions during the owner's lifetime. C. SEP IRA, Simplified Employee Pension. Designed for self-employed and small business owners. SEP IRAs allow employers to contribute to traditional IRAs set up for employees. Contribution limits and rules. For 2024, contributions can be up to 25% of compensation or $69,000, whichever is less. Advantages for small businesses. SEP IRAs are easy to set up and maintain, and there are no filing requirements. D. Simple IRA, Savings Incentive Match Plan for employees. Suitable for small businesses. Designed for businesses with 100 or fewer employees. Contribution limits. For 2024, employees can contribute up to $16,000 annually, with a $3,500 catch-up contribution for those 50 and older. Employer contribution requirements. Employers must either match employee contributions up to 3% of compensation or contribute 2% of each eligible employee's compensation. Differences from other IRAs. Simple IRAs have higher contribution limits than traditional IRAs, but lower than 401(k)s. IV. Self-employed retirement plans. I will now take a closer look at self-employed retirement plans. A. Solo 401(k). Eligibility requirements. Solo 401(k)s are for self-employed individuals with no full-time employees, except a spouse. High contribution limits. For 2024, up to $69,000 annually, $76,500 if age 50 or older, combining employee and employer contributions. Loan provisions. Many solo 401(k) plans allow participants to borrow from their accounts. 4. Roth option availability. Some providers offer a Roth option for solo 401(k)s. B. KEO plans. Types. Profit sharing and defined benefit. KEO plans can be set up as either profit sharing or defined benefit plans. Contribution limits. Limits vary based on the type of plan, but can be higher than other self-employed options. 3. Advantages for high-income self-employed individuals. Can allow for very high contributions, particularly for defined benefit KEO plans. V. Health Savings Account, HSA. Eligibility requirements. Must be enrolled in a high-deductible health plan, HDHP, and not enrolled in Medicare. Triple tax advantage. Contributions are tax-deductible, grow tax-free, and withdrawals for qualified medical expenses are tax-free. Contribution limits. For 2024, $4,150 for individuals and $8,300 for families, with an additional $1,000 catch-up contribution for those 55 and older. Using HSA as a retirement savings vehicle. After age 65, HSA funds can be withdrawn for any purpose without penalty, though non-medical withdrawals are taxed as income. V. Comparison of retirement accounts. V. Strategies for maximizing retirement savings. Diversifying across account types. Consider using a mix of pre-tax and Roth accounts to provide tax flexibility in retirement. Prioritizing contributions based on individual circumstances. Generally, prioritize accounts in this order: 401(k) up to the employer match, then max out IRA, then back to 401(k), then taxable accounts. Considering tax implications in retirement planning. Think about your current tax bracket versus your expected tax bracket in retirement when choosing between traditional and Roth options. 8. Common mistakes to avoid. Not taking advantage of employer matching. Always try to contribute enough to get the full employer match in your 401(k). Ignoring fees and expenses. Pay attention to expense ratios and administrative fees, as these can significantly impact your returns over time. Failing to rebalance portfolios. Regularly review and rebalance your investments to maintain your desired asset allocation. Not understanding distribution rules. Be aware of RMD rules and early withdrawal penalties to avoid unnecessary taxes and fees. Understanding the various types of retirement accounts is important for effective retirement planning. Each account type has its own advantages and disadvantages, and the best choice depends on your individual circumstances, including your current financial situation, employment status, and future goals. Remember that retirement planning is not a one-time event but an ongoing process. As your life circumstances change, you may need to adjust your retirement savings strategy. It's often beneficial to consult with a financial advisor to help you navigate these decisions and create a personalized retirement savings plan. By taking advantage of the appropriate retirement accounts and consistently saving over time, you can work towards building a secure financial future for your retirement years. That's it for this video. It's that time again when I ask you to comment, like and share this video and subscribe to the channel. Remember to let us know topics on accounting and finance that you would like to see covered. See you in the next video.